And welcome to Weekly Profit Talk. Each week, sit down for a few minutes and we talk about the things that will make your medical practice more profitable. We do this every single week, 8:30 a.m. at Wednesday morning. Welcome and good morning. This morning's topic is 3 tax-saving strategies every medical professional needs to know in 2025. And these are hopefully very helpful for you. Now, I'm certain that there are more than 3, but just kind of came across my mind that I need to share this information with you this morning. So let's go ahead and we'll start doing that. That sounds good to you. So first thing is creative deductions for high-end equipment. Now, you've probably heard of the term depreciation. Let me see here just a second. There's what we want. Okay, thanks. Basically, depreciation is expensing an asset over time. Over what the IRS and all of us call a useful life. Things of an appliance nature, which kind of bleeds over into electronics, computers, that sort of thing, diagnostic equipment. These things generally have a 5-year life. So you put something into service, let's say you need an x-ray machine in your office, for example, and they're not cheap. They're easily 6 figures. So you got a couple things you can do. One is if your practice is affluent enough and you suddenly find yourself with a lot of excess taxable income, there are ways to actually depreciate even large assets all in the year that you put them in service, 100%. I'm thinking of the Section 179 part of the Internal Revenue Code that allows this. There are limitations on this, but limitations are in the millions. I think net income is like something over $2 million. Sorry, I should have the numbers memorized, but in any event, that's a possibility. But here is for something that costs you $150,000, let's say, for example, it's got a 5-year life. So in the first year, technically, the double declining balance method allows you to write off 40% in the first year, and then 40% of the remainder after depreciation in the second year, et cetera, with one small thing. The first year, they do this thing called half-year convention. So it is possible to still write off quite a bit of the asset. In fact, it's basically the full 1/5 in the first year. I'm sorry. No, that's correct. 1/5 or 20%. So $150,000, for example, you'd be writing off $30,000 in the first year. That leaves a balance of $120,000 in the second year. Divide that by 4, $120,000. That's $30,000 again. Now multiply that by 2, and you're writing off $60,000 in the second year. And that's how double declining balance works. Why do you want to do that? Because spreading out the expense over a period of years is actually solid tax planning for the future. And if you have the kind of practice that's currently scaling, but you know you're going to hit a point where you're going to have the sort of revenue that you're basically planning for and budgeting for in the near future, then tax planning for a large asset's depreciation over several years actually reduces your taxes in those years in the future as well. And you do want to be in business more than 1 year. So there are different things you can do. And that's basically what I tried to say here in this slide. And additionally, you are also basically in control of that to a certain extent. You can choose year by year which you want to use. It's important to sit down with your tax professional and go over this sort of thing and make sure that you're doing what's best for your tax planning, both this year and future years. So let's see. Number 2, retirement. There are tax saving strategies involved in retirement that are fantastic, actually. I have found with my own business that as an employer, as well as an employee of myself, I've got two different ways to actually add to my retirement. And the employer um, contribution to your I-401k, and the I stands for individual, or they also call them solo 401ks. This can have amazing consequences because you think a typical IRA, whether it's a traditional or a Roth, and by the way, I'm in love with Roth. We'll talk about that in a second. Excuse me. But if you contribute to a typical IRA or investment retirement account, you have a $7,000 limit. It's $8,000 if you're over 50. But we're talking about the kind of things that can save you money either before or after the age of 50, of course, just depending where you are in your practice. But let's say that you are affluent enough in your practice, so you're starting to put away some real net income. You are able to, and let's say, for example, that you have taken advantage of the S corporation election. That means that you have to pay yourself a salary, right? That salary should be reasonable compensation based on the marketplace and also based upon how much you're making in total net income in your business. So what this means is that as the employer of yourself, you are able to contribute up to 25% of the money that you're paying yourself as a wage. So let's say you're taking $120,000 as a salary, and that's a little low for medical professionals, but let's keep in mind too that a reasonable compensation means if your practice is netting $130,000, they don't reasonably expect you to take almost all of it in wage. So your reasonable compensation might actually be less than the typical market salary for your specialty. That's fine. Those are things that we can talk about. If that's making you scratch your head, then we're on 3 different media here. Write your question in the comments, and we'll get to you. And we should probably even have a conversation about that because there are things that we can do there that will also save you thousands of dollars in taxes. But let's get back to your $120,000. I'm just using that as a nice round example. So that means 25% is $30,000 you're able to contribute to your 401k, as well as the amount that you're allowed to put in as a taxpayer. That's $23,500 if you're under 50 and $31,000 if you're over. And not only that, but if your age is 62, 63, or 64, that number is even higher. I think it's like $11,000 additional catch up. So as you can see, there is a maximum of combined contribution that you can make, but this is close to $70,000. And of course, this is just for inflation every single year. So imagine if you're putting close to $70,000 into your retirement every single year into a long-term investment that has and the S&P 500's index funds that basically have returned at somewhere between 9 and 12%. So certainly a lot better than bank interest. If you accumulate that, the compounding power of your money over time is going to provide you a very nice retirement in the future. But that 25% you're putting in as the employer, that's write-off. So that's suddenly also money that you're no longer paying tax on. And that's something that you need to know, definitely. I certainly take advantage of it myself. Last thing, education. Now, this is something maybe you don't think about too much because it's, ordinary and necessary. Everybody's got to do continuing education. Certainly as physicians, you have to. But you can educate yourselves in other branches of entrepreneurship as well as your medical practice specialty. I, for example, actually enjoy researching, and I find once in a while that specific business coaching programs are actually efficacious to my own accounting practice. And this sort of thing, if it is ordinary and necessary to the growth of your business, and that's a simple sell if it is in fact related to the business of growing your medical practice, then that's also a write-off. So that's a thing that you need to keep in the back of your mind. Put that on your radar screen, as it were. There are other ways to educate yourselves other than specialty focused. So with that, I hope you find these 3 tax saving strategies very helpful, and that you're having an amazing day so far today. As February wraps up, we hope everybody's staying warm, dry, and happy, and also that your year is getting off to a great start. We're 2/3 of the way through the first quarter, and hopefully you're making all your goals and finding that your forecasted projections for revenue and expenses are meeting your expectations. So with that, we do hope you have an amazing day today and the rest of the week and month. And looking forward to March, as we are. It's the month with spring in it, after all. So with that, have an amazing day. And if you have a chance, do something randomly kind for a stranger today. With that, so long, and we will see you next week at 8:30 Mountain Time. That is 7:30 in LA, 10:30 in New York. So until then, so long, and we'll see you next week.